Have you heard that it's almost impossible to beat the market and that you should just go ahead and buy index funds and give up? SPIVA even has a chart which shows that 100% of large cap growth funds have underperformed their benchmark over the last 20 years. That's proof, right? Conclusive evidence. Just hold on a second. Now, what got me thinking about this was that I build strategies for a living, and about 90% of the ideas that I would come up with in the S&P 500 would actually beat the S&P 500 over a period of 20 to 25 years. So then I went and I tested hundreds of different factors, and it was true the majority of them all beat the market. That's just anecdotal evidence. So I looked up how long an investor actually holds a stock. The answer is about 5.5 months. So this next simple test just looks at how many stocks with a 5.5 month holding period in the S&P 500 will beat the S&P 500 equal weight index over that period of time. Look at the diagram. The long-term average is 50%. That means it's about the flip of a coin whether you're going to beat the index by holding a stock for 5.5 months. Now hold on just a second. What about that SPIVA scorecard that shows that all of these active funds could not beat their benchmarks? There's a few things you need to consider. One, they're using risk-adjusted returns, sort of like the Sharpe ratio. So you see this chart, this free cash flow factor that beats the market? Well, because there's more volatility, even though it has higher returns, like just under 3% higher annual returns than the S&P 500, it has a slightly lower Sharpe ratio. So this fund is considered to be an underperformer, even though it's beating the benchmark by roughly 3% per year. I don't like their definition of outperformance and underperformance. There's a second problem. Funds have issues such as they have to hold cash for redemptions, and cash drag lowers returns. There's also pressure to shadow index or be similar to the benchmark. It's really hard to beat something when you're just copying it. Funds have management fees, and obviously that's going to lower performance. Another reason that there's just too many positions in a fund. How many good ideas do you think an active fund manager has? 10? 15? Maybe even 20, but what if he has to fill up this fund with 150 stocks? That's like 0.5 beer that's watered down. Now, what are your thoughts? Is it really that hard to beat the market?